Well, Leslie, thank you for talking to me again. We've known each other a long time, and a few weeks ago, I saw a press release from your side of the pond, launching your new funds in sustainable investing, and I felt that I should reach out and get a viewpoint from you just to clarify exactly what it means, because obviously it's a big theme today. A lot of money is rushing into the environment, and quite rightly so, because there's a lot of damage done to the environment, and I think maybe private capital or capital markets need to really be cognizant of the fact that they can really be a force for good and to help, maybe make the world a better place. So if we can get from you maybe a short explanation of what sustainable investing means in terms of potential returns and what it means for investors, Leslie.
Okay, yeah. But firstly, thanks, Trung, for, catching up again. And sure. I think I'll try to address that point when it comes to sustainable investing and this whole new theme that people are very focused on right now. I think number one is, in terms of potential returns, people get the wrong idea, or at least misconception that, ESG or sustainable investing means you have to sacrifice returns. I think we just want to be able to make it clear at the beginning here that it's not the case. You can make money, at the same time, you can make a positive impact. So on top of just looking at your traditional business models, industry trends, earnings growth of a company, I think people start to look at how each individual company or their business is actually doing a better job or doing the right thing for environment, for society, and also providing the right governance when it comes to managing the whole business. So yeah, both financials and also such ESG-related measures are considered when we invest for investors in this fund.
And at least from a headline viewpoint, Leslie, there seems to be some overlap between sustainable investing and Sharia investing, which both have, I guess, headline similarities in terms of ethics and basically trying to do right by each other. Can you clarify the difference between the two?
I think some will say Sharia is actually a subset of sustainable or ESG investment. But I think that, obvious thing is Sharia is actually faith-based. And I think the differences is that they tend to be more towards negative screening. So for example, we all know that, if you're Sharia investors, you don't invest in gaming, pork, anything to do with riba, interest-related businesses. So, people just avoid them. For sustainable investing, people not only look for positive impact, companies that make a difference, people also engage with the companies. They try to push these companies, to do more and to set them targets to hopefully achieve so that it can have a positive impact on E, S, and G.
Okay, environmental, social governance, right? But yes. Traditionally, investors are much more returns focused, right? And especially in Asia, where if I can generalize a little bit, at least from an individual investor perspective, people tend to care less about the environments and care more about returns. Is there an emphasis between the environment and commercial profit in what you're trying to do with a sustainable investing fund?
So we try to achieve both for this fund. We hope to, and so far since inception of the fund, we have actually managed to outperform our benchmark, generate positive returns. So I think if you looked at numbers year to date, we are up about, let's say 18.5%, I think, versus benchmark about around 14 or 15%. So number one, we actually beat the benchmark. We are generating positive returns. Number two, we actually measure the positive impact that we can generate for some of these investors. I know you said about the mentality. It takes time. People, need to slowly get comfortable, get used to the idea, especially here over in the Asia where it's kind of new. People don't necessarily trust you immediately, especially when they say, oh, this is just another theme, another fad, comes and go. Everyone says they want to do green, right? Everyone want to, better to the environment. So what's the difference? So in our case, we try to actually quantify and measure it. So to tell investors exactly, for every, let's say, 100,000 ringgit or $1 million US that you invest in, how many lives you're potentially saving from the vaccines that, people are getting, how many tons of materials are being recycled, how much carbon emission have been reduced because of these companies, because of their capital. Right? So I think once people get used to this, hopefully they'll be more open and it will be just part of normal investing eventually.
So your fund is quite concentrated, I think at most 40 positions at this point in time, and usually in developed markets, not emerging markets, right? So I also noticed that ESG funds, which fall within the benchmark, tend to trade at a premium. And when I look at some of the names here, Microsoft, Apple, Alphabet, tech names, clearly, PayPal is in there as well. Why is that? Why is it that ESG stocks tend to get that premium advantage?
Partly because of also the growth in ESG mandates or funds over the last, call it 3 years or so. So there's a lot of money moving there. People are moving in, and that sort of creates a situation whereby tons of cash looking at limited assets. When I say limited assets, meaning assets that so-called fall under this ESG seed. So people move in, people like the team, they find that this is suitable for ESG. They will start to invest, and it pushes up, the price of the stock, and as a result, the valuation as well. We don't really believe in that because we don't believe in overpaying. Because if you overpay, we might miss out on achieving the returns, right? We said two things: returns and positive impact. By overpaying and paying a premium, you might not be able to achieve that outperformance for your clients. So I think there are lots of people who have chased over ESG assets in the last year or two, especially, and that's why they trade at a higher premium.
Yeah, but then some of the other names in your fund, I want to cite, like, I think Safaricom is in there, not quite a household name. Medtronic, they address the obesity epidemic. There's also companies like Pentair, Clean Drinking Water, Becton Dickinson, PLC, I think. Again, obesity, epidemic, communicable diseases. So not necessarily household names, Leslie. They might not be therefore as deep and as liquid as the Apples of this world. So does that pose a danger in the interim?
No, not really, because while they are not the mega caps that we are familiar with, these are actually within their own industry very big players. If you look at the context of US, some of these companies are in the billions or not tens of billions in terms of market cap. So they provide a lot of very good technology, be it in terms of water purification. You mentioned Pentair. Safari.com is actually operating in Africa, providing payment system via the mobile phone to help a lot of the economy develop in Africa, because not many people own a bank account in Africa for obvious reasons. But their service have allowed a lot of small traders to be able to do business, pay, receive money, settle payments. So it has really helped a lot of people and create economic growth for some countries. So I think market cap wise and size wise and liquidity wise, these are all names that we are pretty comfortable with.
Yeah, and then I guess performance, right? You have taken quite a big step of benchmarking against the MSCI All Country World Index. Those are large and mid-cap stocks across roughly half developed markets and half emerging markets. So over the next 10 years, what kind of performance can you expect to return to investors in this fund?
Typically for these sort of funds, we aim to achieve at least 2 to 3% above benchmark. So if you just look at historical performance of global markets, just as a general guide, right? If you're looking at maybe perhaps if they can repeat a sort of 7% long-term, we were talking about 10, 20 years long-term return, the fund could potentially deliver 9, 10% returns. Obviously, if the overall economy growth is slower and markets returns are slower, the number will be lower. But we still hope to be able to deliver more than the benchmark.
Yeah, so about the same as most actively managed funds, except that the difference is that you get to sleep better at night because you're not necessarily damaging the environment, yeah? But what about the fact that you also were in the press recently as saying that it's looking quite good for risk on assets like equities now? Over the next 12 months, there's lots of liquidity in the system. Equities will make, shares will make good investments. What did you mean by that?
I think, at this point in time, if you compare investing in shares versus what other options that you have or asset classes that you want to consider, number one, let's say relative to bond yields are still at, using just, US Treasury as an example, 10-year, let's say 1.3% today, versus if you put it into the stock market, earnings yield of the stock market is actually 300 bits higher. So you get a yield pickup, right, or better returns as a result. So why not, go for equities? And not only that, I think the liquidity issue is there. And when you look at the sources of liquidity, number one, central banks have yet to pull back stimulus, right? The Fed is still buying 120 billion a month of, bonds from the market or fixed income assets. That's one. Number two, if you look at the money market funds, after the COVID crisis kicked in, money markets fund grew to a size of about 4.8 trillion US dollars. Right? And these money market funds literally own almost nothing. But today, if you look at the numbers, it's only dropped down to about 4.5 trillion. And historically, after crisis, you get about 2-3 years whereby, these sort of funds sort of start to flow back into so-called riskier assets to look for returns. But we haven't seen a big move, in this case, post-COVID. So I think these funds will eventually come out and they will look for better returns. So that's money market, government. But if you look at corporates as well, corporates in the last year, because of COVID, they were very cautious. They pulled back on investment, they cut dividends, they stopped buying back shares, raised a lot of bonds to make sure they have the cash and liquidity to survive the crisis. Now that I can say that the crisis is past, they are beginning to buy back their shares, right? Earnings are also recovered, and sometimes some of the companies are actually back beyond 2019 levels. So we will see a pickup in stock buybacks, especially in the US. So that all these will mean that the markets, it's very well supported. That's what I mean, that there's still a lot of liquidity there.
Well, Malaysia is, I think, minus 9% year to date. So maybe with the exception of Malaysia, or is it a very good time to buy Malaysia now? Not that you know because you're looking more into the world. But then the S&P is up 18-20% so far this year. The Nasdaq is up by about the same quantum. Can markets go higher, Leslie?
I think so. Back onto the point about liquidity. And I think the other part that is very important is as long as the economic growth continues, and the earnings momentum continues, markets can move higher. We believe so. The only issue is we are not saying that markets move one way, right, and one straight line up. Markets never move that way. So if you ask me that, are you worried about a pullback? I say, yeah, but in fact, I'll look at the pullback as being healthy. Occasionally, you do get some sort of pullback. In fact, just within the last month, we had about 2-3% pullback. That's actually good because in this sort of pullback, it's all these funds sitting by the side that's waiting to come in to buy. As long as your economy recovers or normalizes, people like to use all this industry jargon, and earnings can continue to grow. The rate of return might not be as high. Obviously, if you bought during the last 12 months, or at the bottom of the crisis, you made tons of money. Can I make that sort of same return in the next 12 months? Probably not. I can still generate positive returns. I think so.
Well, thank you for talking to me. I guess we can revisit this conversation in 12 months' time and, to see how many trillions have washed into your funds, hoping to make a return so. And try and save the world at the same time. So thank you for talking to me and stay safe, Leslie. Take care of yourself.
Yeah, thanks, Chuang. Stay safe. Take care.